This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Tough slog. Stocks lose ground today, but gain for the week. The S&P briefly hits a new all-time high, but a heavy news week made the ups and downs a little more intense. So what's next for the market?
Double danger. Treasury says a new tax scam is the biggest it's ever seen. And there's also growing concern identity theft is growing through your medical records.
And small giants, our market monitor has small cap names, he says, are poised for big-time gains. All that and more on Nightly Business Report for March 21st, 2014.
Good evening, everyone. Wall Street wrapped up an exhausting week with sharp declines and equally intense gains that sent stocks on a wild ride. It began on Monday with a crucial vote in Moscow to take control of Crimea. But once the threat of a military confrontation eased up, stocks surged. That rally continued on Tuesday, but a day later, Federal Reserve Chair Janet Yellen hinted that interest rates might rise sooner than anyone expected, and stocks plunged. Investors bounced back on Thursday on encouraging economic reports. And finally today, a quadruple witching day for options and futures pulled down stocks. But investors had the final say on the week, pushing the Dow and the S&P up more than 1%. And the S&P even hit a new record in intraday trading. By the closing bell, the Dow lost 28 points, the Nasdaq fell 42, and the S&P slipped 5 points.
The head of the Minneapolis Federal Reserve says the central bank made a big mistake. Narayana Kocherlakota is blasting Fed policymakers' decision not to cite a specific unemployment target in considering whether and when to raise its benchmark interest rate. He says the guidance is wrong and the nation's central bankers should have outlined a clear plan to keep record low interest rates right where they are until the nation's jobless rate falls below 5.5%. The current unemployment rate is 6.7%.
Mike Holland joins us now with his take on the markets and the economy. He's chairman of his own money management firm, Holland and Company. So, Mike, we've gone through a crazy week. Worries about Russia, worries about the economy, worries about interest rates. What's the next worry for investors, or have things calmed down a little bit and we have a break here?
Well, the Fed's behind us. We've had some of the early warning signals from companies that weather hurt the first quarter and so on. So your recap of the week, Susie, was very helpful. Now I know why at Friday night I'm kind of tired. This was quite a week, and yet at the end of the week, yet once again, the S&P, the market was up a little over 1%, and that's been the story for the last 5 years. Since 2008, 2009, we've had plenty of things to worry about, but stocks had become so cheap back then. People have thrown in the towel, and many people the towel is still in the middle of the ring. They have no interest in getting, and stocks are still okay at where we are now. But I think that the next thing to worry about probably continues to be Putin and what's going on over there. We have President Obama over in Europe right now trying to put things, but I think that's probably where the market will focus for a while.
You know, Mike, I'm with you. Stocks ended higher on the week, but it sure didn't feel that way. It was tough getting there. If you were looking for value in equities right now, what kinds of companies would you be lasering in on?
Ty, that it's actually sometimes it gets pretty easy, and right now, if you look at the world, you look at where the U.S. is. The U.S. is probably best situated of all the markets. Within the U.S. market, we have some crazy things like Tesla and Twitter and things like that price, but we have the big quality companies remaining, even though they're up over the last 5 years, they still remain at valuation levels because they've increased their value of their earnings and their cash flow in the basic businesses with strong balance sheets. So you have companies like Intel, Microsoft, Johnson & Johnson, ExxonMobil, JP Morgan. These companies still remain quite attractive on just an absolute basis. And then relative to other things, for example, treasuries and in some parts of the fixed income market, some areas of real estate like London houses, U.S. stocks, the big quality companies, are easily the most attractive thing to me. Sometimes when it gets this easy, you wonder what could be wrong with it. Well, good news is there's numbers.
You know, as you saw today, Fitch Ratings lifted its negative outlook on the U.S. economy. And, you know, we've had some good reports on the U.S. economy this week. Is that one of the reasons that you feel better about investing here rather than in non-U.S. holdings?
Absolutely, Susie. You and I spoke earlier today about the interesting juxtaposition of the U.S. being having its improved Fitch outlook and Russia being downgraded. These are simply facts. Facts are stubborn things. The U.S. looks pretty good. We're probably getting right now this week a few indicators that the spring could be surprises to the upside with the economy. And one of the reasons you can have some comfort in that outlook is that bank lending over the last few weeks has had a noticeable and significant turn. That hasn't been the case for the last 5 years. The Fed has been dying for this to happen, and it's starting to happen. If we get that continuing, and it looks like it may, we could have some really interesting quarters in front of us in terms of surprises to the upside with the economy, which we haven't had in a long time.
Very quick thought on some of those sexy names. You mentioned a couple of them, like Twitter, like Tesla, and there are others that are up a lot, and always the danger is that people want to chase that performance.
And Ty, you and I were around, the two of us, in the dot-com time, and we know that those things aren't over until they're over, but they're craziness. That's exactly right. Once again, numbers are persistent things, facts are persistent things. These things are priced ridiculously high. Wonderful companies, ridiculous stock prices. Then you look at some of these other companies, Apple. You know, you look at Apple and you look at Twitter. You look at Microsoft and you look at Tesla. These are crazy prices for these things when you have really high-quality merchandise over here at really low prices. It doesn't make any sense.
Right. Well, we could go on and on about all of that. Thanks so much, Mike, for coming by. Really appreciate it. Have a great weekend. Mike Holland of Holland & Company.
Another blow to PIMCO, the world's largest bond fund company, already reeling from the sudden departure of Chief Executive Mohamed El-Arian when internal spats with co-founder Bill Gross became public last month. PIMCO has now been replaced by rival TCW Group as the sub-advisor of a new $1.3 billion bond fund being offered up by Columbia Management Investment Advisors.
And more trouble for General Motors CEO Mary Barra. On the job for just 2 months, Barra will have to testify before Congress on April 1st on what the automaker knew about a faulty ignition switch that's been linked to a dozen crash-related deaths, and why the company waited more than a decade to recall 1 million affected vehicles.
A court ruling about so-called swipe fees is having a big impact on some stocks. A federal appeals court upheld the Federal Reserve's cap on those fees, which limit how much banks can charge businesses for handling debit and credit card transactions. It is a big defeat for major retailers. They insist the cap was just too high. Despite today's favorable ruling, it was a split decision for shares of Visa and MasterCard. Those are the nation's biggest card issuers.
An important warning to taxpayers from the IRS about a sophisticated telephone fraud the agency is calling the biggest scam of its kind ever. Callers claim to be with the IRS are targeting tax filers, demanding immediate payment for overdue taxes, and a lot of people are falling for it. Hampton Pearson has more.
With the April 15th tax deadline a little more than 3 weeks away, both the IRS and the top Treasury Department troubleshooter are warning taxpayers about what they say is the largest ever telephone fraud scam. More than 20,000 taxpayers in nearly every state in the country have collectively paid over $1 million to telephone scammers and con artists in recent months. Individuals claiming to be IRS agents on the phone demanding debit card payments or a wire transfer. The scammers threaten their victims with arrest, deportation, or loss of their driver's license if they refuse to pay. The IRS says its first contact with people about unpaid taxes is usually by mail, not the telephone. And no one from the IRS asks for payment using a prepaid debit card, wire transfer, and the agency does not take credit card numbers over the phone. If you owe taxes or think you may owe federal taxes, hang up and call the IRS at 800-829-1040. And this is the second time in the last 6 months the IRS has put out an alert about this particular telephone scam, which, as we said, has gone nationwide.
Hampton, this is really surprising. It just astounds me that people are buying into this. What are the tricks that these scammers are using? They're obviously very persuasive and convincing that it really is the IRS that's calling.
Well, these telephone con artists are intimidating their potential victims by using fake IRS badge numbers. Sometimes, Susie, believe it or not, they even have gotten a hold of the last 4 digits of some of the victims' social security numbers, and also using caller ID phone numbers that look pretty authentic.
Any other red flags on these calls, Ham?
Well, one other final reminder from the IRS. They say their employees will never request personal or financial information by email, text, or any type of social media.
All right, Hampton Pearson reporting from Washington. Thanks a lot, Hampton.
Well, now to the latest type of identity breach you need to know about: medical ID theft, including cyber attacks on all your medical records and data from healthcare companies. It is a growing problem with 50 million reported data breaches each year. Sheila Dharmarajan has more.
It's a classic case of identity theft with a medical twist. These cyber thieves target billing and insurance records because your social security number, address, and credit card info are all in one place. According to a recent study by the Ponemon Institute, cyber criminal attacks on healthcare organizations like hospitals and clinics are up 100% in the past 3 years and are costing the industry more than $5.5 billion a year.
What we find in the marketplace is a financial identity can be worth $5 to $10 if you have all the information. A medical identity can be 5 to 10 times that amount, just because how easy it is to monetize that information once the bad guys get it.
Last year, 40% of healthcare organizations reported a criminal data attack, for a total of an estimated 50 million breaches across the country. And healthcare professionals that participated in the survey expect that under the Affordable Care Act, patient security risk will be increased, as even more information is exchanged between the government and providers. An alarming 88% of organizations report allowing their employees to use their personal smartphones and tablets to access confidential information, including your medical records. Experts say the industry is unprepared for the increase in mobile access.
Healthcare is substantially behind the financial services industry in terms of protecting identities, and it's particularly concerning because these are the most vulnerable identities we're looking at.
Recognizing flaws in the system is the first step to preventing breaches, say analysts. And as hospitals continue to ramp up security measures, they are reporting an increased confidence in their ability to detect future threats. In the meantime, the recently formed Health Information Trust Alliance, in conjunction with the U.S. Department of Health and Human Services, announced last week it will conduct monthly cyber threat briefings to help healthcare organizations prepare for and respond to security breaches. IT security firms like publicly traded Palo Alto Networks and Imperva also provide services tailored for healthcare companies, all with the hope of delivering a dose of protection to patients. For Nightly Business Report, I'm Sheila Dharmarajan.
And coming up on the program, our market monitor has some overlooked names he says need to be in your portfolio. That's next. The losses to the tech industry from the NSA spying program exposed by Edward Snowden could hit an astounding $180 billion. That's according to one estimate. That's why top executives from Google, Facebook, and other internet giants were at the White House today meeting with President Obama about the NSA's surveillance program and demanding privacy protections for their users. John Hardwood joins us now from the White House with more on today's meeting. So we're all curious about this, John. I mean, first of all, who was there and what was on the agenda? What were they complaining about mostly?
Well, you've got Reed Hastings of Netflix, Mark Zuckerberg of Facebook, who complained publicly last week. You've got Eric Schmidt from Google and a series of others. Look, their complaints are partly about privacy, but they're partly about public relations, because remember, the tech companies as well as the administration were embarrassed by the NSA revelations. The administration, because it made them look like Big Brother looking at everybody's communications, and the tech companies because it made them look like the accessories to Big Brother. So in part, they're trying to figure out ways in which the administration can do what it thinks necessary for national security without putting the tech companies in a bad position, and in particular, let them explain to their customers exactly what they're doing and what the justification is for it.
All right, so what do we expect to come out of this meeting, John?
Not a whole lot specifically in terms of new announcements, but we're just a week away, Tyler, from when the Attorney General Eric Holder is supposed to present recommendations to the president for how this program might be changed. And the big change the president talked about was whether or not this metadata can be collected, not stored by the government. So the government doesn't hold it. Somebody else holds it, but the government could have access to it on a timely basis when it decides it needs it for national security reasons. Don't know how that exactly is going to get worked out, but those recommendations could come in a few days. This meeting was part of that process.
Yeah, I mean, a lot of serious issues here. So is this going to be substantive changes, or is it just surface conversations?
Well, I don't think it's going to be all that substantive, Susie, for the simple reason that the administration believes that this is necessary for national security. I think a critical mass of the Congress believes that as well. And you've got to say that the crisis in Ukraine, which is raising tensions, questions about a new Cold War with Russia, certainly helps the administration make the case that, hey, look, we can't let down our guard.
All right. Thanks a lot, John. John Harwood reporting from Washington.
Darden Restaurants reports an 18% decline in profits, and that is where we begin tonight's market focus. The parent of Red Lobster and Olive Garden said those two chains continued to lag. Still, earnings matched analysts' expectations, and despite weakness, the company reaffirmed its guidance for the year. Darden also reiterated plans to spin off Red Lobster despite pushback from activists who want the company to put the move to a shareholder vote. Shares rose more than 2.5% to $50.66. A sizable settlement with Swatch took a huge chunk out of Tiffany's fourth quarter earnings. The luxury goods retailer missed estimates on both the top and bottom lines, and its guidance came in below street estimates. Shares were off a fraction to $90.73. Private equity firm Golden Gate Capital revealed a more than 9% stake in Ann Incorporated. That's the parent company of Ann Taylor and Ann Taylor Loft. And that sent shares of the company way up in today's session. The firm is now the single largest shareholder in that women's apparel retailer. The stock up 13% to $42.05.
BlackBerry reached a deal to sell most of its real estate in Canada in an effort to turn around its business. The struggling smartphone maker gave few details about the sale. We'll find out more about how the company's doing when it reports earnings next week. Today, shares fell 2.5% to $9.18. Media General will buy Lynn Media for $1.6 billion. The deal will create the second largest local TV broadcast company in the country. Shares of Media General rose a fraction to $17.44, but Lynn skyrocketed more than 22% to $26.32.
Our market monitor tonight says if you're looking for big gains in the stock market, think small. He's Eric Marshall, President and Portfolio Manager of Hodges Capital Management. The Dallas-based fund manages more than $2 billion. Welcome. Good to have you with us, Eric. Why do you like the little guys?
Well, we think now is a good time to really focus on individual stock selection and less about really trying to make broad bets on the market or betting on indexes. And within the small caps, you can really find secular growth opportunities. We expect merger and acquisition activity like the one that you just spoke about here a few minutes ago to continue out there, which should really help the valuations of small companies. As larger companies look to grow their business, we think you'll see more and more acquisition activity such as that, which should also be good for the small cap stocks.
All right, Eric, let's go down. You've got a couple of stocks to tell us about small cap stocks. Let's start with the first one on your list, Eagle Materials, ticker symbol EXP. Why do you like it and what does it do?
Yeah, Eagle Materials is a leading producer of both cement and gypsum wallboard. Both of these businesses are in the early stages of a recovery. They're seeing pricing power. And as a result of that, they should be able to leverage a lot of their fixed costs and see substantial earnings improvement over the next couple years. We think at the peak of the current cycle, they could get as high as $10 to $12 per share of earnings power, which if they're able to achieve, we think the stock will be substantially higher here over the next couple years.
Your second pick is Faro Technology. It's a business equipment manufacturer. What do they do and why do you like it?
Yeah, this is almost like an industrial technology company, and they make 3D measurement systems where they're using lasers and such to actually measure things using three-dimensional software. And this is used in manufacturing. It's also used in design and development to speed up time to market for products, as well as reduce manufacturing costs. And as companies start spending on capital investment again, this is a company that should benefit from that. They have no debt, a nice cash position, and we see the company growing double digits here over the next couple years.
Let's talk about another one of your recommendations, ZEP, ticker symbol ZEP. It's trading at $17.85. Why should investors put new money in this?
Yeah, this is a company that you don't hear about every day, and it's not very exciting, but they're a provider of industrial and commercial cleaning products. They make solutions and solvents and stuff like that that's actually consumed in a number of different commercial and industrial applications. And as the economy improves, their business should continue to pick up. We like the valuation. We like the prospects for the company to potentially increase dividends in the future, and they're really a company that's well underneath the radar that I think is worth taking a look at. And ZEP, as well as the other two that I mentioned, are both owned in the Hodges mutual funds, which I have personal ownership in.
All right, so there's your disclosures. Give me some idea very quickly, Eric, of what kind of returns over the next year, 3 to 5 years, you might expect from these companies. Are we talking about home runs? Are we talking about good singles hitters? What?
Well, I think that this is a time to really focus on individual stock selection. And it really depends on what type of risk reward you're willing to take. In the case of Faro Technologies, obviously that stock trades at a much higher multiple, and we would expect to see much faster growth and maybe a little bit slower growth in a company like ZEP, where you're selling cleaning equipment.
Oh, that sounds logical to me. Eric Marshall, thanks very much. Eric is with Hodges Capital Management.
And coming up, how one brewer is dealing with the ongoing drought in the West and making every drop of water count. Twitter is celebrating its birthday. 8 years ago today, it sent out its first ever tweet. But there's no celebrating in Turkey. That's where officials tried to ban access to Twitter after tweets were sent out accusing Prime Minister Erdogan of using court orders to suppress corruption allegations against him. But that censorship attempt failed, as tech-savvy Turks have been able to circumvent the government's attempts to block the service.
Well, not having Twitter is one thing, but how about not having beer? It could happen. The long-lasting West Coast drought is impacting the availability and quality of a key ingredient in brewing, barley. Now, the beer industry is making changes to make sure there's enough barley and suds to go around. Sarah Eisen has more.
Jamie Hart is a barley farmer in the San Luis Valley of Colorado, a valley which gets 85% of its water from snowmelt to the Rio Grande River.
Water is what we live on. It's our lifeblood for our industry.
But there's a problem in the valley. Snowfall in surrounding mountains has been below average for the last 6 years.
It's been getting worse as we go through time here, and we're sure hoping to see the weather change.
That's something barley growers and beer giants like Miller Coors can't count on, especially with barley crop on the line, one of the key ingredients in beer.
Bill Coors is really famous for saying that barley is to beer as grapes is to wine.
Kim Arata is the Director of Sustainability for Miller Coors. One of her key jobs, finding ways to reduce the company's water footprint. Miller Coors estimates it's already reduced the amount of water it uses to 3.9 barrels of water for every 1 barrel of beer. That's less than the industry average. But on the farm, they know they've got a lot more work to do.
What we've learned is that more than 90% of the water is really within our agricultural supply chain. So we can be as efficient as possible in our breweries, but if we're not collaboratively working with our growers and others within our agricultural supply chain to become efficient, we're not going to create scale and we're not going to create impact.
Miller Coors has 850 partner growers in 4 states, including here in Colorado, where nearly 100 growers met this week at the company's winter growers meeting to discuss the growing concern over the water shortage. So what is Miller Coors doing? In addition to the water they have saved at breweries around the country, the company has employed 8 agronomists to work directly with farmers. And they have 2 test farms, one in Colorado and the Showcase Barley Farm in Idaho, where they've used new irrigation techniques, even breeding new forms of barley that are drought resistant.
And through that, we were able to save over 400 million gallons of water in 3 years.
Working with guidance from Miller Coors, partner farms have taken initiative as well.
The older ones are just, they're not as efficient.
Jamie Hart replaced all the nozzles on his farm's pivot equipment at a cost of about $4,000 per pivot, a cost he believes is worth it in the long run.
It comes with a cost, but this water is very precious.
So far, no cost has been passed along to the consumer. But it's certainly something Wall Street may soon be keeping an eye on. For Nightly Business Report, I'm Sarah Eisen.
For more on the new technology and systems being used to make sure your beer mug stays full, go to our website, nbr.com.
And that's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody. We'll see you back here on Monday.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. Wall Street wrapped up a wild week of sharp gains and losses after Russia took control of Crimea, and the Federal Reserve hinted that interest rates might rise sooner than expected. Stocks fell today, but investors had the final say on the week, pushing the Dow and S&P more than 1% higher. The Dow lost 26 points, the Nasdaq fell 42, and the S&P hit a new intraday high before slipping 5 points. Top executives from Google, Facebook, and other internet giants met with President Obama over user privacy in the wake of the NSA spying program. And an appeals court upheld the Federal Reserve's cap on so-called swipe fees, limiting how much banks can charge businesses for debit and credit card transactions. Be sure to tune into Nightly Business Report right here on your public television station.